JamesOLoughlin, The Real Warren Buffett, Managing Capital, Leading People. Dive into the brilliant mind of Warren Buffett, one of the world's most successful investors, as we explore JamesOLoughlin's book, The Real Warren Buffett, Managing Capital, Leading People. This book reveals Buffett's management and investment strategies, the transformation of his approach due to Charles Munger's influence, and his ability to focus on important and knowable information. Throughout the summary, you will gain insight into Buffett's circle of competence and how he capitalizes on market inefficiencies to make calculated decisions, ensuring consistent growth and success for Berkshire Hathaway and its partners.
Warren Buffett's fourth box philosophy. Warren Buffett's business philosophy centers on focusing only on what is important and knowable, as he believes that anything else is unimportant or unworthy of attention. He divides business into 4 boxes, disregarding the first 3 and dedicating his time to the 4th box, labeled important and knowable. This box defines his margin of safety, his circle of competence, and the limitations of his strike zone. Buffett operates according to the truths he holds self-evident and meets the expectations of his shareholders and partners within this box. Despite knowing that the market may be efficient in the long run, Buffett acknowledges that it is not always reliable in providing a stock price equal to a company's intrinsic value. According to him, standing alone holds no fear, allowing him to step away when prices deteriorate and bask in the loneliness of being logical. The cigar but investing strategy. Warren Buffett's early investment strategy involved identifying undervalued companies using Ben Graham's method, which led to significant growth in his partnerships. Buffett referred to this as cigar but investing, where even a small profit was worth it, and his success in an era where many stocks were undervalued has inspired many. Ultimately, he sold his stake in Dempster Mills to acquire Berkshire Hathaway's stock, meeting his second mentor, Charles Munger. The wisdom of inaction. Warren Buffett's success in investing is partially attributed to Charlie Munger, his West Coast philosopher and advisor. Munger, while lacking formal training in business or economics, has a remarkable intellect and intuitive grasp of investing. Munger advised Buffett to transform his areas of knowledge into circles of competence, consistently stress-testing his beliefs for truth. Buffett learned that in moments of strategic stillness, how investors are motivated to act or not to act matters. While in the textile business, Buffett realized that competing on price while consuming capital for new tooling, improved distribution, and expanded marketing was unsustainable. He stayed too long in the business, misled by the hopes of dominating a highly competitive market. His interactions with Munger enlightened him about staying true to one's knowledge and ability to accomplish more through strategic inaction. Although strategic plans are common in most corporations, they often block essential changes and never call for strategic inaction. Buffett says that Berkshire Hathaway's unique advantage is that it doesn't operate with a strategic plan, except for waiting for fresh opportunities. Buffett's success in investing lies in his ability to stay true to his knowledge and resist the pressure to exceed previous achievements, over and over again, as advised by Munger. The Munger Influence. Munger's advice to Buffett on decision-making processes, the importance of experience, and the power of mental models led to Buffett's transformational shift in approach to business from an entrepreneur to an allocator of capital. Munger taught Buffett to invert situations and to focus not only on intellect but also information and experience. Through rigorous self-evaluation, Buffett realized how much more successful he could have been, and his businesses went on to generate 15% yearly profits. Buffett's investment strategy. Warren Buffett's investment strategy involves selecting good businesses at fair prices and focusing on what is permanent. He prefers investing in businesses with low costs, managerial excellence, and those that cannot be overcome by any important, unknowable event lurking at the margins of technology. Buffett did not invest in the technological revolution of the 1990s as it was beyond his circle of competence, and he focuses on business processes that generate statistical backgrounds. He reduces his exposure to risk-intensive equities by merging with General Re, which promised a vast float. He purchases several businesses as the market tanks, which exemplifies his embrace of volatility. Ultimately, Buffett's objective is to be in the investor's equivalent of the Baseball Hall of Fame. Buffett's brilliance in the face of tragedy. On September 11, 2001, Warren Buffett's insurance and reinsurance companies faced an unprecedented loss scenario. However, Buffett saw it as an opportunity and emerged as the dominant insurance seller in a market where premiums were sky-high. In May 2002, he invented the world's first negative interest loan vehicle called Scores, which offered investors 3% a year and a warrant to buy Berkshire stock at a 15% discount. The investor also paid Berkshire a 3.75% installment premium on the warrants each year. This move helped Buffett raise $400 million and prove that his company could survive beyond anyone's expectations. The book argues that in a world where companies generate linear streams of earnings, management to expectations has become endemic in the CEO community. However, Buffett's unconventional approach and ability to see opportunities in tragedy gave him an edge over his competitors. The Berkshire Way. Berkshire Hathaway's CEO, Warren Buffett, is against short-term focused analysis and practices that bedraggle CEOs and common shareholders. The company doesn't pay dividends, simplifies its annual report, keeps its incentives as actual costs, refuses to use a marketing firm, and cares about investor comfort. For Buffett, a CEO should worry when investors buy and sell frequently. This approach defies conventional principles and corporate norms but aligns with the view that market efficiency isn't perfect.
In conclusion, The Real Warren Buffett unveils the secrets behind the Oracle of Omaha's unprecedented success in the world of investment and business management. By honing his circle of competence and learning from mentors like Ben Graham and Charles Munger, Buffett mastered the art of identifying undervalued businesses and allocating capital efficiently. His unique perspective on the stock market's inefficiencies and his unwavering commitment to maintaining a long-term partnership with his investors are notable hallmarks of his approach. Embracing inaction when needed and investing in solid, well-performing companies at fair prices, Buffett's management philosophy has stood the test of time, making him an icon in the world of business and finance.